Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz, and we'll start the conversation.
Today on the podcast, we have Joe Fang returning. Welcome back, Joe.
Hey, Gary. Hey, everybody.
Well, today we'll have a back and forth talk about macroeconomics, current deal we closed, and just share what we're seeing in the marketplace today.
Yeah, Gary, it's nice to be back with you, at least speaking in public. These are always fun, and hopefully our audience can get something out of the things that we talk about internally and what we're thinking about. So, Gary, as you mentioned that we recently just closed on La Posada Apartments, which is now called Icon on Headley. Could you tell the audience a little bit more about it?
It's our 11th deal in Tucson, 13th in Arizona. So we focus, as you know, on a few markets. We could be experts in those markets. We're not chasing deals all over the country. It's hard to be really good when you don't have a level of expertise in a market. You're just chasing deals, which as you know, we don't do. This is only our third deal in the last 2.5 years. Icon on Headley is a 1999 build, 136 units. 78% are 2 and 3 bedrooms, which is great. And it cash flows from day one, 5%, which is fantastic. It's kind of different from some of our other properties where we've averaged a 40% bump in NOI across in the first 12 months across our portfolio.
Yeah, Gary, you mentioned previously that these two are sister properties, Icon on Midville and Icon on Headley. Could you maybe talk a little bit about the synergies that we might be able to get from having two properties near each other?
Yeah, so exact same layout, builder. We bought Midvale at the end of December. We actually tried to take both of these two down originally. We got it off market, sent to us. We said this is what we were willing to pay. The seller only sold us Midvale at the time. They were looking for a higher return. Ultimately, we kind of met midway on the price. But yeah, less than a mile away. So we can have, instead of a property manager and an assistant manager and a maintenance tech and a maintenance supervisor at each property, we can now stack it and have a maintenance tech, a maintenance supervisor, and another maintenance tech. So 3 on the outside, and a property manager, an assistant manager, and a leasing agent, that they all rotate between different properties. So we have 6 staff instead of 8. That'll save over $100,000. Now, we'll have some different investors for each property. We'll have different financials, but they'll be run as one property, which is really beneficial. It was saving a lot of money. We actually have 2 other properties in that area as well, within a mile or two. So we can really leverage that leads and staffing and whatnot as we see fit, which will really help our properties.
Well, that's great. Now, Gary, I think our investors know that we really focus on just multifamily residential. But just even within that asset class, you have different investment strategies from, working on light value add all the way up to deep value add. Where do these two sister properties lie in our sort of, within our investment strategy spectrum?
Yeah. So, like I said, they're a little bit different than some of our other properties, but they're both light value add. So, we'll do about 15% of the remaining units as far as renovation. We just started the signing package is done. It's on Icon and Midvale. Headley should be done in the next week or two. And what we'll do more so on Headley because there's a little bit more space on that property. So, the pool has a very small seating area and a bunch of like landscaping rocks and whatnot. We'll actually get rid of a lot of that rocks near the pool area and add a much better kind of resort-like feel to it by adding more seating, pergolas, a barbecue area. We'll also add a dog park to the property, which whenever if we have space and they don't have one, dog park is one of our favorite amenities to add. It costs us up to about 15,000 when you include the toys and the signage and everything, but it really goes a long way because so many people have dogs and it's just a really, really nice amenity. For Cabo, we'll also update some of the landscaping, but we just don't have the space to add more seating and whatnot. It actually has a pretty decent amount of seating, but we'll also add a barbecue there. So the barbecues are pretty cheap. Maybe built in, you're talking about $10,000, but it's a nice feature that our residents can take advantage of and have get-togethers and grill some food together, which is always nice.
Yeah, as an investor in all of our deals, it's great to see that we can go up and down the spectrum. You know, I think the overall net effect of all that is, you're going to be able to get more cash flow up front on some of the deals, and then more higher return on the back end for some of the deals that require that require more work. So really is nice to blend it all in, especially like in our impact fund, where one investment will gain you access to all the different investment strategies that we offer. On that note, Gary, can you maybe tell us a little bit about what you're seeing in the multifamily market right now? Like what's going on with deal flow? Is it starting to pick up or?
Yeah, when we were at NMHC, I guess the end of January, and met with all the brokers in our key markets, and deal flow is definitely picking up. It's not where it was still in like 2021, maybe beginning of 2022, but we're starting to see good deals. Um, like I said, we did one deal in 2023, one deal in 2024, but I feel strongly that we're going to have enough quality deals where we're going to do closer to the four to five deals in 2025. Again, we're not going to do a deal just to do a deal, but the quality of deals that we've been going after are really impressive. There's two right now that we're really excited about. And just because we're excited about doesn't mean like we're going to get our price and we'll get the deal, but that's very positive to us. And we continue to see deals that we feel are significantly below replacement cost and some value add component. So one is the heavy lift with no cash flow. One is a really nice, core plus asset. Cash flow is nice from day one. So yeah, different strategies. We're just trying to look for the best value for our investors. So we'll see how it plays out. We never know until we get something under contract and do our due diligence, but definitely excited to see investor sentiment pick up. I know investors have been burned by some deals, and we can kind of get into that later, but there's a tremendous opportunity out there. And we've talked about this many times. As Warren Buffett says, be fear. I forget that. Be fearful when others are, going crazy and investing, and take advantage of the time when others are fearful. But it's a perfect segue right now to kind of jump into macroeconomics, which is your specialty. So why don't you kind of let us know what you're seeing out there?
Yeah, thanks for giving me the time to kind of talk about one of my biggest passions is understanding how the world works and moves. Frankly, a lot of other, syndication teams don't even worry about this, and it's, I don't know. I think this is something that's good to know. So interest rates, this is a topic that like it's been on everyone's minds. It's particularly applicable to real estate industry, but in fact, it impacts everybody because this is the cost of doing business, and the last 2 3 years, this has been a topic on everyone's minds, and so even as of right now, the headline risk is still worried. People are still worried about inflation, but I mean, if you look at the data, though, the interest, or I should say, the inflation rates have been coming down. This latest February CPI print came in at 2.8%, which, we haven't had a two handle in a long time. And non-farm, payroll came in weaker than expected. Unemployment rate is inching up. Earlier this year, the markets were pricing in one cut in 2025, and now it's up to four. So in a short amount of time, the market can change expectations very quickly. Um, I do believe that um, rates, will start to come down, most likely in the second half of this year. If you follow the 10-year US Treasury yields and as well as the 30-year mortgages, they have been coming down meaningfully, in just the last 3 months. Um, Nobody knows what the rate of change is, and how quickly, if at all, rates are going to come down. But let me just offer the audience this. Our government, the US government, has up to $10 trillion of debt that they also need to refinance this year. Okay. And just by, understanding incentives, the Fed would rather do this, try to refi at a lower rate than at a higher rate, or even at the current rate, right? So they're going to do everything they can to try to, influence rates down. So if I, was a betting person, I am. I would expect to see the 10-year US Treasury below 4% later this year, and then the 30-year mortgage at around 6% again later this year.
Yeah, I think every real estate investor would be thrilled to see that. And it's the last 6 months. It's been such a roller coaster. We saw it dip quite a bit, go back up, dip again, come back up a little bit. I mean, it's if you could time it, which is super super hard, you'd be a very rich man. But it's been interesting when we were trying to lock our loans and watching it go up and down and trying to at least get a feel for like, okay, where we feel comfortable and taking that risk off the table. Very 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 hard to gauge. Talk about tariffs. That's obviously one of the, besides AI, that's one of the biggest things I think everyone is talking about. And how does that affect real estate?
Yeah, this is a good question. And again, this is something that's like on the news every single day. And the first thing that jumps to people's minds is that, oh, tariffs equals, asset inflation, because when you add again, adding the cost of doing business, a tax, if you will, then somehow that's going to end up translating into higher asset prices, right? Well, again, let's look at the data. And before I give you some examples, I just want to caution people, when you look at data, when you look at specific metrics, when you just focus on on various key metrics, in and of itself, right? If and not understand it in a context of other moving parts that are actually counter cyclical or counter each other, it's very hard to really, get a full picture of what's going on. Now, and here's I'll illustrate my point with this. Back in 2017, 2018, during Trump's first administration, he also implemented various tariffs, right? But if you follow the prices of appliances, steel, and solar panels, just for example, they went up. The prices actually went up in the first 90 days, and then they came down for the rest of the year. Okay. Now, I haven't studied enough to figure out why that is, but these are some of the potential reasons. It could be manufacturing, reshoring. It could be simply the fact that when prices go up, guess what? People stop buying, and so there goes your demand, right? Or yeah, it could be a number of other reasons. Like here's another example. Just was it a week or two ago? Taiwan Semiconductor, which is one of the world's largest chip manufacturers, they announced that they were going to spend $100 billion setting up a shop, in the United States, and so something like that, is a potential net beneficiary part of having tariffs. Oh, by the way, most of that money is coming to Arizona. Just one of the reasons why we're there. So anyway, I just want to caution people, like, don't just automatically, jump to conclusions. There's a lot of stuff. There's a lot of moving pieces, and you have to take it all in. Okay. The other side of it is that, for those of us, whether you like Trump or not, doesn't matter. He has a way of doing things, right? The art of the deal, so to speak. And he likes creating a lot of short-term chaos, a controlled demolition, if you will, and they have an end goal in mind. It's not really apparent what it is, but what Treasury Secretary Besson says is that they are trying to target trade agreements with our partners that's a little bit more pro-American, and basically encouraging them to buy our long-term debt, which we need to get the rates down. And then, once we get our inflation under control, you see the stock market coming down, animal spirits dwindling, people spending less, that will slow the economy down a bit, and therefore, the Fed can, begin to cut rates. As far as impact to real estate, it's not inconceivable to think that, this could have a negative impact to material costs, and Gary, you want to speak to that? I don't think we're seeing any meaningful price increases right now. But again, I said earlier that you don't want to look at anything by itself, because for example, in a slowing economy, you can see that in new housing start permits, the builder sentiment, layoffs in the construction field. Those things will actually counter, any material increase in any increases in material costs, right? So again, not everything happens in a vacuum, right? And so let me finish by saying this: we as real estate operators, we can only control, what is in front of us. Gary and Tim, they're experts at squeezing, performance out of properties. I've witnessed them with my own eyes. They're so good at it. But that doesn't mean that, he or Tim, has influence on when the Fed's going to cut rates, right? And so all we can do is do the best that we can, making sure the properties perform at peak levels under any condition. But again, I spend a lot of time understanding macro forces just so that we know, what we're up against.
Yeah, and for those that don't know, Tim is our asset management manager here at Break of Day Capital. He's great at what he does. But yes, we've got to control the controllables. We can't worry about whether we like the president or not. Or so when we took over Icon and Spanish Trail, we projected to grow the NOI over 29% in the first year. And quite a bit of it was based on the income side. And we did, I was really impressed with our ability to boost NOI over 500,000, and very, very little of it came from the income side of things. And then some of that was already in our business plan. So like we said, control the controllable. So we did a low flow project for the property. So when someone flushed a toilet before takeover, they were using 3.5 gallons. And once we hired a crew, and within a month, in 1 week, they changed over all the toilets from 3.5 gallons flush to zero point 0.8 gallons. So significant water savings. We also added aerators to the shower heads and faucets. Again, reduced water consumption. And so that's saving well over $150,000 a year. And when you divide that by the cap rate, whatever you choose, 5-6%, you're talking about millions of dollars of value created for that property. Now, they had an insurance claim a few years back. And so we were saving $50,000 on that because we got different insurance. They also had an additional staff person that we felt wasn't needed for this property. So another $50,000 saved there. We also saved on some general admin costs and some repair costs. We weren't able to increase rents on new leases. Actually, for a while, we actually lowered rent to boost occupancy, and that drove up our NOI. We also instituted pet rent. It didn't really. It's not a huge number, but even a little bit helps. Even 10,000 when you go to sell divided by the cap rate is you're adding hundreds of thousands of dollars of value to your property. We also added privacy patio walls to the patios on the first level, so 126 units. We're charging $75 per unit. Now we didn't capture a lot of that money in the first year because first we had to install it and then it's on the new leases. But in the second year, we'll be able to capture a huge amount of that, which will allow us to keep driving that NOI up and up and providing greater cash dividends to our investors. But as far as tariffs, how they'll affect our CapEx budget, yeah, we've got on properties that we're looking at, we'll build in about a 25% increase in those costs so that we do have a margin for error. Now, do I really believe the cost is going to be 25% higher? No, I do not over time. But I think, we certainly made a mistake on the deals that we were looking, that we bought in early 2022. And I think many others did. A huge increase during COVID and thereafter of supplies and labor really jumped up. So in some instances, we were below what we needed for that CapEx. Now, luckily for us, we built in a lot of other buffers for HVAC and plumbing and roof. And so things certainly break over time, but not everything breaks, over the course of your deal. So it just gives us some padding for these variances that may pop up. So that really helps protect us as well. But you've got to, insurance. If you're not building in a massive increase in insurance over time, you're hurting, and no one could have guessed the amount of increase that insurance increase in costs. Even for us in Tucson, we're seeing a huge increase, and we're paying the price for other states, I believe, because we don't have those natural disasters. But it is what it is, and you've got to have that increase in your underwriting. You can't have a 2% increase in costs or even a 3% for insurance. If you haven't taken that big jump yet, you've got to be 8, 10, 12% higher than the year before, growing. So, this is, like we said, control the controllables, and gives you buffer and margin for error.
Yeah, that sounds good. Always, try to stay one step ahead.
One of the things I also wanted to mention was, we talked about interest rates, was capital stack, and then how you're putting together deals these days, because it's you do have some choices. There's agency debt, which is leverage is a lot lower than previously, and then on Icon, on Midvale, and Headley, we chose life company debt. So the rate is actually a little bit higher. but the costs are significantly less. So it comes out to about the same, and there's a lot less prepayment penalty, which we like. So obviously, for every deal, we kind of look to see what the rates are, what are the costs, all these different variances, and make the decision of what's best for that deal. But there are options out there. You got to shop around. So we use a loan broker to really vet the different options out there. If we're using a new company for debt, have they worked with them before so we understand what we're going to be facing? If they say we've used them before and they're a pain in the butt to work with, that's someone that we don't want to do business with, because we have faced that in the last couple of years, and even on properties that we've been performing well on, perhaps that lender is under duress because of some of their other deals, and we're paying a price where they're just not easy to work with. So that's been a struggle that we face. So making sure we work with a lender that is easy to work with and they're not under duress.
Yeah. Yeah, definitely. I think that, the financing piece is such an important part of structuring a deal, and, to be able to put on the right type of debt and leverage, the amount of leverage, the duration and all that. Not only does it safeguard the deal, but also, take into consideration where we are in the cycle, we'll be able to navigate, through rough waters if necessary.
Yeah. And I think I just learned of another guy I know who's had a good reputation, is facing a lot of heat. Anyone that bought a deal, not anyone, a lot of people that bought deals end of 2021, 2022, put on a lot of leverage, this bridge debt, this short-term debt. We did it on a bunch of deals as well. Luckily, we performed very well on those deals and got way ahead of it. But certainly, feeling squeezed on a couple of deals. Haven't had a capital call. Hopefully, we never have one. I can't guarantee we would never have one, but it's been a struggle on some deals facing the you know that leverage piece, and I could name a couple deals where I wish we raised a little bit more money, had a little less leverage to give us a little bit more room to breathe as interest rates have stayed higher and much longer than anyone could have predicted. And you've got to really build in those safeguards to be able to ride through, really not even a recession, although some people have said we've had a recession, but that those interest rates spikes, you've got to build in all these different safeguards to protect yourself, to protect your investors, because we have seen a number of deals where they've gone under or they've had capital calls, and some investors are skittish, and they have every right to be. But that's why it's so important to go to invest with operators that have been doing it a long time, don't promise the world as far as IRR, have lower leverage, have enough working capital, have done a number of deals in that submarket, and that goes to our book, Invest Smart, Spotting Red Flags in Real Estate Syndications, is making sure you know what questions to ask a syndicator before you invest with them.
Yeah. No, Gary, this is real. I'm so glad you brought all this stuff up, because it's not always rainbows and unicorns. This is why investors pay us to deal with any potential issues, and frankly, the last 3 years, the way that interest rates shot up so quickly, it really took a lot of people off guard. I mean, some people say like, oh well, the Fed took a year, to raise rates from almost a zero to over 5%. Yes, but the market never believed they were going to go that far, and it's like, it's just kind of like you think the news is going to stop tightening, but they just kept going and going and going. Like, you know, I don't even know what the last time they did something like this. It must have been like 40, 50 years ago. And as you stated, the operators who are not serious, they were already in trouble even before the financing got bad. We know some competitors that were already down to like 65% occupancy. Like, what the heck are you guys doing? And then, on the other hand, there's some big prominent names out there that, did too many deals in such a short amount of time. They grew too fast and just did not have the liquidity to backstop all these deals, and, we were not immune. There were, a couple of deals that, we, didn't put on the, the best, debt type of debt for that to handle that kind of situation. But, I'm at least proud to say that, we've been through the worst. Not only have we survived, we didn't cause any distress to our investors. We backstopped them. But we're on the verge of thriving. I don't know what the sentiment is exactly like right now. Some people are still skittish, but you talk to the family offices and some of the smaller institutions, private equity funds they're chomping at the bit to like get back into real estate.
Yeah, I think over the last year or so, we've never had so many big checks invested in our deals before. So it's there's plenty of money out there for deals, and there's a bunch of really good deals out there. So it'll be interesting to see what transpires over the next year or so. Yeah, what transpires with tariffs, what transpires with interest rates, what transpires with a number of deals that still need to be, their debt has expired, or they've been extending and pretending and whatnot. Obviously not a tsunami of deals, but it'll be very interesting next 12 months as far as real estate opportunities and whatnot.
Yeah, I'm definitely excited to see what's to come.
Yeah. Well, Joe, love talking real estate and macroeconomics with you. I appreciate you coming on. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.